Hi and welcome back to Business 101. I'm looking forward to telling you all how we're going to calculate ROI. So please follow the example that I have here.
Today we're looking at how to calculate return on investment. ROI tells us how good the company is at generating a profit on invested money. This means that ROI, or return on investment, tells us how big the profit is compared to how much money we have invested in the company. We'll also calculate it by having net profits divided by total investments times 100. ROI can be used in many occasions, and today we're going to use it on calculating the return on investment looking from an annual report, so the total return on investment in a company. When we're looking at it from a company point of view, of course, we'll look at the income statement and the balance sheet. Here there are two examples. Company 1 has a net profit of 2.5 million and assets worth of 50 million. ROI is then calculated by dividing 2.5 million with 50 million times 100, and this gives us a ROI of 5%. Company 2, net profits of 100,000, assets worth of 500,000, and again ROI is calculated by dividing the net profits with the total assets times 100, and this gives us a ROI of 20%. So company 2, even though they make less money than company 1, they have a better ROI. Now, is that then a better investment? Not necessarily, because ROI should always be correlated to risk. This means that the higher the ROI, the higher the risk in the investment. Of course, this is not always the case. You might be able to find possible investments where you'll get a very high ROI at a relatively low risk. And these are, of course, the investments you should look for.
Thank you very much for watching. Please subscribe if you like my video. I'll add more videos about business, about economics, about marketing, about innovation later on. So see you again soon. Bye.